What have we learned from working with one of the biggest multifamily investing mentors in the industry? Instead of just telling you the answer, we're going to show you because why not? Here's the deal. We've got a multifamily property on our hands and we're going to run it through 5 tests. These tests will determine if this multifamily property is worth investing in or if it's just another dud.
A 200 unit deal, 1971 build. It's in Georgia, a market that we love. $28 million, or at least that's what they're looking to get for the property.
And to spice things up, Kenneth and I decided to place a little wager. If this deal passes all 5 tests, I'll have to buy Kenneth Chipotle. But if it doesn't pass, he buys me a bowl. These are really just tips, which we learned from our mentor Mark Kenney. We're calling them tests because it sounds cool. He's the founder of Think Multifamily and he's currently managing over $1 billion in assets. So if these guidelines are good enough for him, then they're good enough for us.
Oh, I wasn't recording. 3, 2, 1.
Let's start with the first test, the renovations test. We need to know how much it will cost to upgrade this property and determine if it's worth the investment.
In the industry, we actually call it CapEx. We overestimate our CapEx budget or our renovation budget. As you guys can see, the property itself is in good condition, but it is just very dated. Now, I would live there, right? It's very livable. It's just old looking and hasn't been renovated. Now, look at what they've done to the place. They've added new cabinets, backsplash, granite countertops, stainless steel appliances, new flooring, new plumbing fixtures, lighting. Look at the bathroom, granite countertops again, light fixtures, mirror, flooring, tile in the shower. This is a 2-bed, 1 bath. $1,500 to paint the whole place. We'll likely spend about $3,000 for kitchen cabinets, brand new shaker style cabinets, granite countertops. $1,800, and this would include in the kitchen as well as in the bathroom. We're going with the stainless steel appliances, which will run us about $2,400. Bathroom, shower, and tub is basically the tile. It'll be about $500 to do that tile work. The vanity, $350 for a new vanity. Flooring throughout the apartment, LVP flooring, $1,800. Light fixtures, a little bit on the heavier end, $1,000. That's because we're probably going to be doing recessed lighting. $500 on miscellaneous, whether that's doorknobs that you need to replace for some reason, door stops. So that brings us to the total of $12,850 for renovating this one unit. At this property, there's a total of 200 units and we're only going to renovate 80% of them. So that'll leave us about 160 units that we're going to be renovating. With the knowledge that we have and the renovations that we know we're going to do, and in knowing what we're going to spend, we are still pretty close to what they're looking to get for the property, and it meets our return, so it's a check mark for renovation. One step closer to beating Kerwin.
Now it's time for the rent bumps test. This is where the big bucks are at. We're going to determine whether the property has the potential for rent bumps and the expected return on investment. But we need to make sure we aren't being too aggressive in our rent bump assumptions.
Guys, everyone and their mom was smoking crack the last 2 years. There were some markets in the last 2 years that grew 20% in rental increases. We do not assume anything very aggressive. 3.5%, 4%, I'd say max, maybe pushing it 5% if it's a very strong market, but even then, I think it's a little too aggressive. Let me just show you what that does. Some people were using 10% and then they would escalate down. So let's say 7 and 5. Let's keep it at 3. So as you can see, you go from $1,000 year 1 to $1,100 on 10% rent growth year 2. By year 3, you've grown $177 without touching the unit. By year 5, you've grown $272 without touching the unit. This is aggressive, as I mentioned. We're realistic. We try to stay conservative.
Whatever.
3.5%, and then keep it going down. Look, by year 5, it's only grown $136 in 5 years. If you increase your income, you increase your value. It's a business that you're buying, so it's valued on how much money it produces. Without us having to be aggressive, this property definitely checks our boxes because we don't have to assume very high rental increases to get the projected returns that we're looking for our investors. On to the next check.
The rate cap test is where things get interesting. We need to make sure we're not putting ourselves in a difficult financial position down the road. With this test, we'll make sure that we budget for a rate cap.
If you're not capping your rates, especially in this environment, you are exposed to a lot of risk. If rates go up higher than you actually projected, you can then fall within a position where you're now cash flow negative, meaning that your interest payment on the property and on the loan is low lower than what the property itself is producing. And you never want to be in that position because that is how you lose the property. Take a look here. Originally, our closing costs, it's usually 4% of the purchase price. And that totals to $1,120,000. That's what normally our closing costs would be. But now we have to factor in the rate cap on top of our 4% closing costs, which brings us to a total of $2,270,000 for closing costs on this property. It pretty much doubled. If you're not factoring this in and you come to the closing table and in order to close, you have to come up with $1 million, that will hurt your returns if you're not factoring it in already. The reason it still works is that with the money allocated to the rate cap within the closing costs, we are still meeting our return because of course we have to raise the money for closing costs and it meets the investor's return that we're usually looking for. On to the next.
Next up, the income test. This is it, the moment of truth. We've learned it's crucial to make sure the average tenant's income is 3 times the pro forma rents. This way we know that the tenants will have enough money to actually pay the rent.
Bring it in. As you guys can see here, when I click in this area where the property is kind of at, there's $43,000 in income. As you guys can see, this area directly has $63,000 in income, and then the one north has $50,000. So if you average it, it's probably higher than $43,000. We're gonna use $43,000, and it's a little bit lower than we were expecting. Our performer rent on average is $1,500 per month. Performer rent is really just your projected rent or what you think and believe you can get after renovating the units. We look to get a yearly number as to what people should be making to be able to afford that performer rent. So monthly, they have to be making 3 times the performer rent, which is $4,500. And if you multiply that by 12, like I said, annual is $54,000 is what they likely should be making in order to justify our performer rent. And as I mentioned, ours is a little bit low at $43,000.
And finally, the crime rate test. We're not just looking for a property, we're looking for a safe community. No one wants to invest in a property that's located in a dangerous area. We need to make sure the crime rate in the area is low or this deal is a no-go.
So you don't want crime at the property or around the property. This can affect your terms with your lender. It can even affect you not even be able to get a loan with a lender. Interest rate can be higher. Investors can just shy away because it's a higher crime area. Usually we get a crime report from the police department or the local police department, but for the sake of this video, I'm gonna show you guys spotcrime.com. They do a really good job. They're pretty accurate. So as you can see here, there isn't much crime, which is good. It's a good sign. Let's just see a little bit north. No crime. Okay. There was some crime here. It was a theft. But in the direct area right here, there is no crime. So that's a good sign. That's a good sign. This passes the test. There's no crime in the area or on the property, which is a great thing. Although I did like the curb appeal and I did like the renovations, the price and median household income was a little low. It didn't pass the median household income test. We're not going to be submitting an offer on this deal. Aww. I guess I owe Kerwin some Chipotle.
Yeah, he does.
Which meant that I, Kerwin, was a winner. But it was a bittersweet victory, because while the chicken bowl was delicious, the win meant the deal didn't work, which was an L for the team. But this was just a reminder of something our mentor taught us.
It's important to have investment principles because if you have principles, you can stick by those even when you're a little bit emotionally invested. You're not emotionally making a decision. If it's not a good fit for our investors and we don't feel like it'd be a good investment, then we're just gonna pass.